Thank you for being here today. We're at the threshold of a transformation, one that could redefine the way we interact with money, markets, and even trust itself. Today, we are not just talking about a price movement. We are witnessing a narrative shift, a signal from regulators, innovators, and legislators that the future of crypto in America is not only possible, it's being shaped right now. The headline that captured everyone's attention this week was Ripple's XRP token rising after ProShares received SEC approval to launch 3 new futures-based ETFs tied to XRP. This isn't merely a win for XRP holders or Ripple. It's a symbolic milestone, an indication that regulatory clarity, long demanded by the crypto community, may finally be on the horizon. This development followed the resolution of Ripple's long legal battle with the Securities and Exchange Commission. For years, that lawsuit cast a shadow over XRP's potential. And now, with that cloud lifted, ProShares stepping in with SEC-sanctioned products is a green light not just for XRP, but for innovation, participation, and investor access. We haven't yet seen approval for a spot XRP ETF, and that remains a significant milestone ahead. But the fact that futures-based products are now moving forward signals real progress. It creates legitimacy. It invites institutional capital. It validates the years of work done by developers, exchanges, and advocates for change. XRP is now part of a larger trend, joining Bitcoin and Ethereum in gaining mainstream investment vehicles. This is no longer a niche. It's a growing ecosystem with real traction. On the day of the ETF announcement, the broader crypto market had mixed results. Bitcoin traded flat, just under $94,000. Ether saw a slight dip. XRP, meanwhile, rose about 2%. While this may sound modest, the meaning behind that movement is deeply symbolic. Markets don't only respond to numbers, they respond to signals. And this one said, something is changing. We are witnessing a shift in how crypto is treated, not just by investors, but by regulators and institutions. It's not about chasing the next speculative wave. It's about designing infrastructure. It's about compliance. It's about maturity. On that same day, Coinbase's chief legal officer, Paul Grewal, made headlines of his own. He penned an open letter urging the U.S. Office of Government Ethics to revisit an advisory that prevents SEC staff from holding crypto assets. His reasoning was simple and fair. If conflicts of interest can be managed in traditional finance, like real estate or equities, they can be managed here too. It's a call for fairness, for understanding, for bridging the cultural and legal gap between regulators and innovators. Grewal wasn't asking for special treatment, he was asking for equal footing, the kind of footing that allows this industry to be regulated by people who truly understand it. But Coinbase wasn't only addressing the US government, they were also looking outward toward the global investment landscape. This week, they announced a Bitcoin yield fund, a new product designed to offer institutions between 4% and 8% yield in Bitcoin over a full market cycle. Redemptions and subscriptions are made entirely in Bitcoin. And while it's not available to US investors yet, the implications are global. Bitcoin is traditionally seen as a store of value, a kind of digital gold. It doesn't offer native yield like Ethereum or Solana. So when a firm like Coinbase creates a structure to provide yield on Bitcoin, it's breaking new ground. The structure of that fund must involve lending, derivatives, or sophisticated financial engineering. That introduces risk. Coinbase believes it can manage that risk. If true, this becomes a meaningful offering for institutions wanting to put idle Bitcoin to work. While the private sector moved fast, things were heating up in Washington too. Republican Senator Cynthia Lummis called out the Federal Reserve this week for what she described as lip service to crypto innovation. Her concerns stemmed from the Fed's recent withdrawal of letters that had previously discouraged banks from engaging in crypto. At first glance, this looks positive, but Lummis argued that deeper regulatory barriers still persist, things like legacy risk models and outdated reputational fears. Even though the Fed has taken steps to reduce hostility, there remains a disconnect. Statements labeling crypto as unsafe and unsound still loom in the background. If the US truly wants to lead in financial innovation, these half measures aren't enough. We need real change, clear rules, a mindset that welcomes innovation rather than fearing it. That's why it's so important to highlight what happened at the SEC later that week. The Crypto Task Force at the SEC held a policy roundtable on digital asset custody. It was only the second roundtable of its kind and the first under newly confirmed SEC Chair Paul Atkins. But what stood out most wasn't the topic, it was the tone. Attendees described the event as a true pivot. One attendee, Veronica McGregor, the chief legal officer of Exodus, called it a 180-degree shift. For years, the SEC has taken a litigation-first approach to crypto. Companies were punished before being properly guided. Innovation was stifled by enforcement rather than supported through collaboration. But now, for the first time in years, the tone was open, constructive, thoughtful. The new leadership at the SEC under Atkins seemed willing to listen, really listen to what the crypto industry has been saying all along. Veronica McGregor's message at that roundtable was focused and powerful. She spoke about the vital role of self-custody. In a world increasingly filled with centralized exchanges and custodial wallets, the idea that users can hold their own assets is revolutionary. It's not about avoiding oversight, it's about personal sovereignty. With a self-custody wallet, users hold their own private keys. That means no one, not a company, not a hacker, not even the government, can access those funds without permission. That also means the responsibility is entirely yours. Lose your password and no one can help. But the reward is freedom. McGregor pointed to the most infamous hacks in crypto history, Mt. Gox, FTX, Celsius, and noted that virtually all occurred within centralized custodial systems. Self prevents that. And she warned that if regulators fail to protect the right to self-custody, we risk turning crypto into just another version of the old system, one with even more complexity and fewer protections. Her message was echoed by many. It resonated because it wasn't just theoretical, it was practical, it was urgent, and it was heard. Chair Paul Atkins, though only days into his leadership, made a visible difference. He participated in panels, he engaged with guests, he showed a willingness to lead by listening. Attendees left with a sense that something had changed. That perhaps the walls were coming down. This wasn't just good politics, it was good governance. Meanwhile, Exodus continued to push for change outside the SEC. Their political advocacy included support for the Stand with Crypto PAC, a movement that has already shown real impact. It's no longer enough for crypto to exist in the margins. It must be present in Washington, in policy meetings, and at the polls. If crypto wants to shape the future, it must also shape legislation. Veronica McGregor also spoke about how to build effective compliance teams in this space. It's not about saying no to innovation. It's about asking, how can we make this work safely, legally, responsibly? The best lawyers in crypto aren't obstacles. They are bridges between technology and law. They are translators between code and compliance. And so we come back to where we started. We are at a turning point. The approval of XRP-linked ETFs was not a finish line. It was a signal. One that told the world, crypto is no longer a shadow industry. It is stepping into the light. The legal battles, the policy shifts, the institutional products, all of it adds up to something larger. A future that's being built not just as code, but by courage. Not just by companies, but by communities. Not just by price charts, but by principles. The conversation is no longer, should crypto be allowed? The question now is, how will we build it together? Because make no mistake, the door is open. The momentum is real. And the future is already arriving. The only question left is, will you be part of shaping it? Thank you.